friends. Welcome to the third video on Learn Stock Market from Scratch series by the Wall Street School. Now, in the previous video, we have understood about the financial statements, the income statement, the cash flows and the balance sheet. And you would have realized that everything is a number. But if you want to understand the company, it is just not about number. That is half cooked. You want to understand that in greater detail and in a more granular manner, we have to understand the company from the qualitative side and the quantitative side. The quantitative side has been taken care by the financial statements. The qualitative side is taken care by the annual reports, which is supposedly the Bible. You might not have understood some of the terms above, but not to worry, we'll cover them in this video. Now, what can be inferred from the annual reports? The USP of the product, the industry in which the company is operating, whether the company has a duopolistic or a monopolistic position in that particular domain. Is the industry doing good or not? Related party transactions, salaries withdrawn by the promoters. So by end of the video, we'll try to make a conscious effort to understand the annual report. And we'll also see from the annual reports how can we gauge the quality of the management, whether it is siphoning of funds from the company or it is good. So let's get started. How to read annual report of companies. Friends, you know what? J.K. Rowling, she became a billionaire writing books. Jeff Bezos, he became a billionaire selling books. And Warren Buffett, he became a billionaire reading books, reading so many annual reports, getting a sense of the companies and the industries. So in our Kurukshetra of the stock markets, the annual reports will be our Bibles and the Bhagavad Gitas, which will give us a broad level sense of the company and the industry in which the company is operating. What we get from the companies are plain, blunt data. How do we make stories from it? How do we make inferences from it? That is something, a skill that we need to learn. So in this video, let's try to acquire as much as possible. Okay, at a broad level, these are the sort of inferences that we need to make from the annual reports. The first one, the sales fall or rise, profitability fall or rise, business environment understanding. Why the sales are rising, why the sales are falling? Are the sales continuously decreasing and are the margins intact? Is the company cyclical? If there is a continuous fall over a period of 2 years, that's a sign of worry. Just ignore the quarterly sales because the industry could be cyclical. This is something we can try to understand from the company at a broad level reading the annual reports. The second one, the management evaluation. What we can see is the shareholding patterns, investor complaints, management remuneration. How much of money is the promoter or the key management withdrawing from the company? The third one, related party transactions. Is the cash being siphoned from the business? Are minority shareholders being compromised by diverting funds from the company? And the fourth one, debt. What's the company's strategy to service the debt? What are the inherent debt obligations which the company has? If the long-term debt has become a short-term debt, because if it's a short-term debt, you are supposed to repay that within 12 months. How are the working capital limits of the company? So all these inferences we'll try to comprehend from the annual report when we are assessing and analyzing any particular company. So in this particular video, what I'm going to do is take up some examples of some of the annual reports so that you understand at a broad level, because what we are getting is just plain data. So we have to be sharp enough and shrewd enough to try to comprehend the stories from those numbers and read between the lines. Because once we are able to develop that skills, we'll become more shrewd, we'll become more savvier. Okay, and let's assume that, let's be cautiously pessimist that anything is something which does not fit our eye, is something is wrong, and let's assume that ways. And let's not give the benefit of the doubt to the company. Let's give that benefit of doubt to ourselves. We may be wrong, but let's assume it that way. Okay? Because see, we are trying to analyze a company from an outside in perspective. So in this onwards video from now, I'll try to take some examples of some of the companies so that you get a gist of the broad level sense that we need to understand while reading an annual report. Okay, now this company, just the first basic cursory glance of this company called Temptation Foods. I have their 2008 and 9 annual report. Now understand, if it's an annual report, it's a reporting document and it's not a publicity material. And it should have minimum number of pictures. It should be more meatier in terms of content, more meatier in terms of the discussions and about the future of the company per se. Now let's see this. Just a quick perusing of the annual report of this company. This is way back 2008 and 9 annual report. Just quick and dirty browsing. Now see this. This is Temptation Foods. Now these are the annual reports. All pictures, all vulgar pictures, obscene pictures, dirty pictures. And this is I'm trying to understand this company. I'm trying to think that I have to invest in this company, and this is what I get. Wasn't that very distasteful? Because it's a question of your and my money. Would you want to put your money in a company like this? That's the first reflection of what the company is all about. Now the management is all about filth, cheapness, obscene. Straight away, no, not even going into more granularity into it. Straight rejection for me, and it was not a surprise when I see the financial performance of the stock price performance of the company, 2008-9 onwards. This is how it has been. Singular one-way fall. We got to respect your and my money. We have to put money. It's a very pious thing. Understand? It's a lot of hard work. We cannot just put our money in filth and see our money, just being consumed and lost just like that. No. Another very important ingredient we need to understand is the salaries withdrawn by the promoters, because the promoters are the ones who are running the company, and from the company's profitability, how much of salaries that they are earning, that's an important ingredient to understand. Now with respect to the salaries, let's take some example. You can see this guy Virendra Sehwag. Now the great part about Virendra Sehwag was that he did not do any biasness for any shot making, be it a T20 international, be it a one day, or be it a test match. If there was a ball to be hit, there was a ball to be hit. Right? So a similar inference here in this company called Ruchira Papers. You see the annual report of 2018, and you see the key employees of the company in terms of their remuneration. So Mrs. Praveen Garg, Deepan Garg, Lucky Garg, Atul Garg, and so many different people. So Praveen Garg has almost 25 years of experience. Deepan Garg has 19 years of experience. Next guy has 15 years, 18 years, 10 years, 9 years, 12 years of experience. But the remuneration of everybody is the same. No biasness. Irrespective of number of years of experience, no biasness. Now this means what? For me, this is very weird. I mean, I may be wrong. As I said, I'm okay to feel wrong. I'm okay to feel cautiously pessimist about any company that I see with a hawk eye, being cautiously pessimist about the company. But let me have that benefit of doubt on the company than on my own mind or on my own judgment. Now you see this. Now she is Vice President Corporate Social Responsibility with 25 years of experience, getting this much of remuneration. But it's getting the same remuneration. All the key employees. Now this might be a company's ideology, but for me it looks like weird. And the weirdness does not stop here. The weirdness does not stop here. Because if I probe a little further, I go to 2018 and 19 annual report, I see the total expenditure on corporate social responsibility. it's a necessary expenditure as per norms of the Companies Act, that you need to expense out certain portion of your net profits into corporate social responsibility. In 2019 it was around 66 lakhs. In 2018 it was around 45 lakhs. Okay, no problems here. The problem is over here, that Mrs. Praveen Garg, who is the Senior Vice President Corporate Social Responsibility, her salary is 55 lakhs and she is handling a project in which the total expense is 66 lakhs. I mean, her total salary is 55 lakhs and she is handling a project worth 67 lakhs. Now, this is weird for me. I may be wrong, but I mean, I'm not comfortable with these numbers on the face of it. Now, the company doesn't say anything. This is an inference which I've tried to get from looking into the company the way it is. Okay. So here you go, like this. And when all is well, the stock price came crashing down, despite the fact that because of the ban on plastics which the government proposes, there's a lot of emphasis on the paper industry, and Ruchira Papers is one of the prominent players. But looking into the financials, I'm not very comfortable the way it is. Just plain annual report. My inference. Another company. See this. This company called HEG Limited. It's a leading manufacturer and exporter of graphite electrodes in India and operates world's largest single-site integrated graphite electrode plants. Now, if you see the sales here, the sales were falling to 29%, fell by 1%. This was spectacular. 220% growth in the sales, 140% growth in the sales. Phenomenal numbers. Net profits was in the red in 2017. Phenomenal profits. Profits 1,000 crores and 3,000 crores of profits. And the operating profit margin, so this is my operating profit margins, from 9% it grew to 62% and 70% operating profit margins. Wow. But you can clearly make out that the operating margins are vulnerable to the movement in the raw material prices of the company. Okay. So I went to their 2018 and 19 annual report. The company says that 2018 and 19 was a watershed in the history of the company, as the winds of the change completely altered the dynamics of the business, spiraling the company's performance to an all-time high. Great. And the company acknowledges that these opportunities don't come often, and we have tried to make the best of it by spotting the emerging trend early, maintaining our poise and sticking to our strategy undeterred, keeping focus on our quality and blah 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 blah. Fine. In their 2018 and 19 annual report, it says the profitability margins we just saw in their financials achieved will not sustain going forward, for that is a once in a lifetime achievement. But the margins could see settle down at par with global sectoral players, and this reduction would be primarily owing to a decrease in realization from graphite electrodes and stuff like that. So company is acknowledging that it was a shot in the pan. It happened, might be a fluke, might happen again, might not happen again. But having said that, so that's the first sign of being risk averse and just not going by the momentum of the company per se. But another thing which I need to ponder over here is 2016 and 17 annual report. The promoter of the company, Ravi Jhunjhunwala, he earns a total salary or total remuneration of almost 2.3 crores. This is 2016-17, the year when it was in red. Next year, 2017-18, 1756% increase in the salary, and the total salary jumps from 2.3 crores to 43 crores. Next year, because it has been a superlative year, from 2 crores to 43 crores increase in the promoter's salary of a company in which you and I are a shareholder. And you can see the profitability of the company being squeezed by the phenomenal salary earned by the promoters, but you and I are minority stakeholders. What do we do? And it does not over here as yet. See, next year, hold your breath. Next year, 2018 and 19, from 43 crores, the salary jumps to 121 crores. 2 crores, 42 crores, 121 crores. Company said it was once in a lifetime, and company said make hay while the sun shines. Definitely the promoter made hay while the sun shone. However, see next year, and when you see, so this is till 2019, so this is when the superlative profits were there, and next year, and see the fall from 6,000 odd to 2,000 odd, 67% fall in the sales. The profitability from 3,000 crores, it became 67 crores, and that's it. So when you know it is superlative profits, you are making your own remuneration superlatively, perhaps the largest in India. And it's for God's sake, it's your and my money. And we being minority stakeholders would not have much say. But you can make a sense of the integrity of the management. What is more important from them, their own net worth or the companies per se? Because we have invested in the company, your and my money. And we are seeing a squeezing of the profits of the company because the promoter's salary has increased from 2 crores to 42 crores to 121 crores in 2 years flat. And it's not a surprise for me when the stock price of the company went up. And this is what happens. A lot of tizzy happens, a lot of frenzy happens, going up, going up, going up. The next big thing, most of the people would have put money over here. And most of the people will be sitting here, or they might have made an exit here. That's what happens with 90% of us, 90% of the time. That's why people lose money in the stock markets. We just need to be a little more suave in terms of what is happening. And you see this. In the words of the great Warren Buffett, he says, honesty is a very expensive gift. Do not expect it from cheap people. Now I was scrutinizing the financials of this company called Virat Crane Industries. It is engaged in the business of manufacturing of ghee. So if you see the sales here, so every year you can see almost a steady increase in your sales. Every year, sort of increase in their operating profit, some outliers, but the profits are increasing, which is okay. You see the balance sheet of the company, the net block of the company is rising, the borrowings of the company are very insignificant, and reserves of the company are rising. So most of the checks are happening in the way we would want them to be. However, if you peruse through the annual report of 2019 for the company, on page 54, it says, according to the information and explanations given to us, the company has granted unsecured loans to 4 bodies mentioned below, covered in the registrar maintained under this, in respect of which the terms of the loans do not stipulate any repayment schedule, and the loans are repayable on demands. The loans bear no interest. Now this means what? The loans to Virat Crane and this are outstanding from a long time, and no provision has been considered by the management in the accounts. Now, I'm a shareholder of the company. I know that company has given loans to somebody else and there is no accountability. No interest is being charged. How weird is that? Now, you see, it's a clear case of siphoning of the funds for me. I might be wrong, but I have reasons to believe that this is siphoning of funds which is happening here. Because the company says there is no overdue amounts in respect of the above loans granted to the bodies, as there is no repayment schedule and bears no interest. This means what? Not acceptable. For me, as a minority stakeholder, for me it's a big turn off. Out of this company, want to look into this company again. Now, not a surprise for me if you see the stock price performance of the company. Here it is and it has been a one way, just one way, because promoters are squeezing out the money from the company for their own benefits. Why would I want to put a company in which the promoters are more interested in their own self than in the company? We just need to be a little more suave, a little bit of hawkeye, and a little bit of cautious pessimism with respect to any company, and put on that investigative hat in on our head, just trying to comprehend the numbers and what the annual report says. And believe me, no analysts would track or give you inputs like this. This is something which we have to make inferences at our own end. In the words of Charlie Munger, he says the liabilities are almost always correct. It's the assets when most of the naughty works happen, most of the siphoning of the funds happen, and we need to be wary of it. And that wariness will come by comprehending and understanding the annual reports in a more lucid manner. Now let me give you another example. Another company, Sterling and Wilson Solar Limited, very famous promoters of the company. The company came out with an IPO in 2019. IPO price of 775 and 780. Okay. It was subscribed fully. And if you see the prospectus of the company says that it has given loans to related parties. It has given loans to related parties of almost 19,354 million. They come on board with an IPO, and as of now they have given unsecured loans to related parties of 19,000 and almost 19,500 million. That's a substantial amount which they have given. Whom do they have given? To these different players, in which any of the director or partner is a director or a member. Now, so this is one first red flag, that this is a substantial amount which has been given by the loan to a company in which the director or a partner is a director or a member. Okay. Now, next year, so if you see next year, the company says that they have given promoters one more year to repay the loan. I mean, what is that? They are still awaiting full payments of the inter-corporate loan that the company extended to its promoters before the public offering. We saw that in the prospectus. The company has now extended the repayment timelines by one more year. And why? Just because they are promoters, they can do whatever at their own whims and fancies. What happens to you and I as shareholders, if at all we are? Our voices won't be heard. What if we do not approve of it? But we can't do anything about it. So we just adhere to and just see what is happening. But we make a sense. We can make a definite sense that there's something wrong that is happening here. And the promoters of the company, this and through letters have sought extension of the loans to facilitate repayment of the entire installment of 500 crores. For me, it's a perfect example of a horrible corporate governance. Because you cannot, if it was due, it was due. And I mean, who are you to grant extension just because it's the promoters in their own private, in their private capacity? You have given loans. And remember, part of happiness, friends, of life consists not in fighting battles, but in avoiding them. And you understand why I'm saying so, because the promoters, they defaulted on Union Bank commercial paper worth 200 crores last year, September 30, 2020, they defaulted. And you see a ripple effect. Franklin's 5 debt funds in crosshairs as they defaulted in it. If you remember, Franklin closed many of their debt schemes because the defaults happened. It's all a ripple effect which is there. And it is not a surprise for me if you see the stock price performance of the company. It has been just one-way trajectory from the time it became, the IPO came in 2019. So this is what it was. Let me give you an example of another company, S. Chand and Company, their IPO. If you remember, most of the books that you and I would have read in our schools, in our colleges, must be published by S. Chan, because it's a very famous publisher. So if you do a bit of Google in terms of a review of the company, a lot of all positive reviews, and the company's IPO was oversubscribed. The IPO price was 670 rupees. It was oversubscribed by almost 60 times, by 6 times by the retail investors, non-institutional investors, qualified institutional investors, and so on. So almost 60 times oversubscribed, which is great. But what is not great is the fact, if you go through the financials of the company before the IPO came. Now this was as per the prospectus, 2012, 13, 14, 15 and 16. These are the numbers. Now if you see their share reserves of the company, this is rising. Every year it is rising, which is good. The borrowings of the company is rising, and this has fallen here. Okay. The short-term borrowings of the company are rising, and the fixed assets are almost there. The intangible assets are rising, which is okay. A very significant portion of their current assets is trade receivables. Now what is a trade receivable? I've rendered my goods and services to somebody, but I have still not received the money. But the accounting norms I'll give me that part that I can show it as a sales. So my sales, my receivables are rising, and rising significantly. This is a big number. If you see their overall thing, this is a big number. And if you see the revenues of the company, so the revenues of the company are rising, but there is a significant amount of trade receivables. I have rendered my goods or services, I have rendered, but I have still not received the money for it. So if this be the case, this is a significant portion. I have reasons to believe, and I might be wrong, but I can make that inference. I have reasons to believe that it might be a fictitious sales, because it might be a fictitious person to whom I've made the sales, but I don't know. And nothing else is there in in terms of financials, the way it is normally growing. See, I might be wrong. I'm okay to be, but I said I'll be more cautiously, negatively biased towards any company if I look into any financials. And the same thing over here. And for me, it was not a surprise. Not a surprise. If I see the stock price performance of the company since the IPO came, it has been a one-way trajectory. One-way trajectory. It's still not over yet. See, understand what you are using the money for. Why you are using the money for. You're coming out with an IPO, you want to go for expansion purposes, but you're using the money for what purpose? You're using the money for repayment of the loans availed by the company. Repayment in full or in part of certain loans availed by the company. This is as per the prospectus. This is how you're going to use the money. Wow. No, the money is not being used for expansion purposes. The money is being used. Imagine the company is coming out with an IPO. The money is being used for repayment of the existing loans. No, I'm not comfortable with that. But who reads prospectus, friends? Who give the buy recommendations? For any company. Do you know when you watch a movie, you first thing is you go to the reviews of the company and of that movie, and then you say, okay, let me go and watch a movie. Who gives the review? Suppose you've seen a 4-star review or a 5-star review and some amazing comments about the company, about the movie, and then you watch the movie and you feel, kya tha movie mein? What was there in the movie? The same thing happens over here. Till the time we do not make our own efforts, till the time we do not make our own inference, rather not do it. Let's be more savvy, let's have that more hawk-eye, and let's make our inference accordingly about a company. Now see this. Another company called Indo-Borax and Chemicals Limited. It has a market capitalization of 70 crores. If you see the financials, this was the capitalization around March of 2020. So market cap of almost 70 crores. Okay, not a problem. But the problem is, one fine day, the company comes out with a notification which says, that I'm going to use the money. I'm going to use the money that the board of directors in a meeting held on March 12, 2020 has approved to invest almost 42 crores in residential property in Mumbai. Wow, 70 crores market capitalization of a company. 42 crores is being used to buy a residential property for the promoters. Wow. And we all feel that as shareholders, we want to use the money for the growth of the company. The company is going to use the money. The company is going to use the money for their own growth. For me, it's a clear case of siphoning of the funds. Not acceptable. Now, Bakarangi, it bought stake in PC Jewelers for 112 crores. This is a little dated news, January 25, 2018. And so Bakarangi is a banking and financial service provider. It bought stake in PC Jewelers. So if you think of both the companies, this is like chalk and cheese. There is absolutely no match, no synergies. Could be something on the face of it. I do not understand what it is, because it's chalk and cheese here. And the weirdness is that if I see the annual report of Bakarangi for 2017-18, there was absolutely no mention of PC Jewelers investment. No mention in the 2017 and 18 annual report. That to me is a sign of lack of transparency by the company. And if I'm not surprised if I see the financial performance, the stock price performance of the company 2017-18, it has been a one-way trajectory for the company. Now, how do you read the annual reports at a broad level? Just see the structure, the business overview, the management reports, the financial reports, and the other things. This is Hindustan Unilever annual report of 2018-19. I have the overview of the company, about us, chairman, management committee, and then the different reports of the company, then the financial statements of the company, and then the consolidated financial statements. I want to see more meat. I want to see more text, not photographs. Okay. So that I can see what the management is talking about. I can see how the financials of the company are. I can see what is the strategy of the company onwards. That will give me a sense of confidence and as to what is the management's ideology of going forward, and stuff like this. So their total overall numbers about what the company is all about. And how to actually read the business overview, the business model. It should be easy to understand. It should make economic sense. Should be in a sunrise industry, so that you're comfortable as to the financial performance of the company. Also, with respect to the chairman's letter, it should address the current year performance. It should increase the faith and the confidence of the investors. Now, this is Airtel's letter to the shareholders in the year when Jio had come and it had disrupted the entire telecom sector. So it said that India witnessed unprecedented market disruption following the entry of an extremely well capitalized and aggressive new operator, acknowledging that the competitor is there. However, Airtel navigated this extraordinary challenge with well thought out strategic action plan and of course sheer resilience. Many small operators lost their bearings. The shake-up triggered an industry-wide consolidation process, which we believe could prove beneficial for the market in the long term. So I know, if I'm a shareholder of Airtel, I know that the management is not oblivious of the fact that a new player has come. They acknowledge it, and they know that this is a normal recourse of any business, and they are at their end rock solid to ensure that they've also grown their business. They are more resilient. And they've seen considerable strengthening of our spectrum footprint both through this. So I know as a matter of fact that the company will weather the storm, or the management is capable enough, acknowledging that there is an issue, acknowledging that there is a big competitor, but they at their own end, they are competent and confident in terms of their own capabilities. That's what I want to see in a company. So friends, in this video, I've tried to make you aware of the broad level inferences that we have to make while reading annual reports, because what we get is just plain blunt data or text. So we have to learn reading between the lines so that we are more savvier, we have more hawk-eye, and we understand the company and its futuristic direction. Okay, in the detailed stock market wizard series that we have, We have, of course, gone much more detailed, much more granular in terms of trying to understand companies with many more examples per se. But I hope this made you understand how to read annual reports at a broad level and what all things that you need to look into. So I'll wind up this video with this famous quote by Horace. Is a very famous Roman poet. He says, "Many shall be restored that now are fallen, and many shall fall that now are in honor." So we have to try to read between the lines, become more severe, and see how to read the annual reports so that we can separate the boys from the men. I hope you have liked this video. I'll see you again in the next video. Thank you.